This course is about the basics on investing, not about speculating. What's the difference? Well, although they both involve risk, when you buy an investment, you put your money in an asset that generates value or a return. For example, a part of its return or value may come in the form of an income return such as dividends or interest payments. Part may also come from the fact that the investment is creating value or wealth. It is earning money and plowing that money back into the investment so that the investment itself appreciates in value. Real estate pays rent, stocks appreciate in value and oftentimes pay dividends, and bonds pay interest. Even if the stock isn't paying dividends, now such as with Google's common stock, it is creating wealth or value and appreciating in price. It is the return that the asset generates now and will generate in the future that determines its value. Speculation, on the other hand, involves assets that don't generate wealth or a return and involve a much higher level of risk, and in general, you are hoping for a very high return. Gold coins and baseball cards, for example, are worth more in the future only if someone is willing to buy them at a higher price than you paid when you bought them. Their value depends entirely on supply and demand for these assets can change quickly. As a result, an asset of this type is considered speculation. Other examples of speculation include comic books, autographs, Beanie Babies, and gems. It's the same as betting on the Super Bowl in hopes that you will make a lot of money quickly. You can make a pretty penny speculating. The first issue of X-Men comic book appeared in September 1963 and cost 12 cents. 48 years later, it was worth over $13,500 in near mint condition. That's an appreciation rate of over 27% per year. But be warned, you can also lose a lot through speculating. Just look at Mark McGwire's 1985 Topps Tiffany card. It sold at a peak price of $10,000, but in 2011 it was down to $15. The same thing happened to Jason Gamby's 1991 Topps rookie card, peaking at $400 before falling to $7 in 2011. Why did the value of these cards drop so much? No one wanted to buy them. It all boils down to supply and demand. People have speculated for centuries. In the 16th century, for example, Dutch farmers speculated in tulip bulbs. One recorded trade had a single bulb being exchanged for the following: 17 bushels of wheat, 34 bushels of rye, 4 fat oxen, 8 fat swine, 12 fat sheep, 2 goats' head of wine, 4 kegs of beer, 2 tons of butter, 1,000 pounds of cheese, a complete bed, a suit of clothes, and a silver drinking cup. Today's new variation of speculating securities is derivatives. Derivative securities are those whose value is derived from the value of other assets. These include options. An option gives the owner the right to buy or sell an asset, generally common stock. In other words, if the asset is not of value, you don't have to exercise the option. The price at which the option holder can buy or sell the asset is specified. In addition, options have an expiration date, and there are 2 basic types of options: a call option, which gives you the option to buy the underlying asset at a set price on or before the option's maturity date, and a put option, which gives you the option to sell the underlying asset at a set price on or before the option's maturity date. With options, you find the buyer and seller are, in a sense, betting against each other. For this reason, the options market are often referred to as a zero-sum game. If someone makes money, then someone must lose money. If profits and losses are added up, the total for all options, ignoring the trading costs, would equal 0. To say the least, the markets are quite complicated and risky. In fact, some experts refer to them as legalized institutions for transferring wealth from the unsophisticated to the sophisticated. These derivatives can be extremely dangerous. For the beginning investor, options should be considered speculative in nature. In short, they're not something to rely on to achieve your financial goals. With investing, as opposed to speculating, the value of an asset is determined by what return it earns. Investments have intrinsic value because they produce wealth and income, and although in the short term their price may wander a bit from their intrinsic value, in the long run the price approaches the intrinsic value. Investment is less risky than speculation, and the value is based on how much income the investment is producing now along with what it is expected to produce in the future. Certainly, investing is not as exciting as speculation, but exciting is not that great if it means losing your nest egg. This lesson was pulled from Personal Finance, Turning Money into Wealth by Arthur J. Keown, a textbook that was part of one of many finance courses I took in college. I found that this lesson is one of the most important concepts to understand before you start investing. If you found this episode helpful, please give it the thumbs up and share it with your friends. If you feel inclined, please like us on Facebook, subscribe to our YouTube channel, follow us on Twitter and Instagram, and if you really want to, subscribe to Gennecho's weekly newsletter. We will give you all sorts of advice, tips, and strategies to all things finance and investing. Just click the link below and enter your name and email in the form provided. Thank you so much for watching and have a great day.